Most traders are completely distracted by the political circus on X. They're arguing about who said what at a rally or which agency chief just got fired. But while the retail crowd is distracted by the noise, the real money is moving based on signatures on pieces of paper that nobody ever reads. These are executive orders, and they aren't just laws. They're instant market rigging mechanisms that pick winners and losers virtually overnight. We aren't talking about politics here. I don't care about the ideology. I care about the liquidity. We're talking about 5 specific documents that just tilted the playing field for 2026. If you understand the fine print, you can front run that reaction. Now, let's look at the first order that literally changes the price of doing business. Everybody sees trade war headlines and immediately panics about inflation or consumer prices or who knows what else. I mean, that's the standard retail reaction. You see a tariff, you think, whew, that's going to be an expensive iPhone. And you kind of get nervous or scared about it. But the real story, the one that the algorithms are trading on right now, is the artificial price floor that's being created for domestic heavy industry. This is effectively a government-mandated margin expansion for very specific sectors. And if you aren't engaged with this trade, you're missing out on the most obvious setup on the entire board. Let's look at the math that matters. The reciprocal trade order isn't just a flat tax. It's a mirror. It says if a country charges us 50% to sell our goods there, we're going to charge them 50% to sell their goods here. On the surface, that sounds like a fair fight. But for a trader, this is a volatility engine. It means the cost of goods sold for U.S. companies is now tethered to foreign policy decisions that can change on a Tuesday afternoon tweet. Specifically, look at the 50% tariffs on imported aluminum and steel. This isn't a subtle nudge. This is a sledgehammer. When our government slaps a 50% tariff on foreign metal, they aren't just punishing China or Europe. They are handing a massive gift to domestic producers. Think about it. If you are a U.S. steel producer, your foreign competition just got 50% more expensive overnight. You don't have to be quite so efficient anymore. You don't have to innovate. You just have to be cheaper than the guy paying the tariff. You can raise your prices by 40%, expand your margins to levels that, well, you probably haven't seen in decades. And you're probably still the cheapest option on the market. This is the rig. Foreign competitors get priced out by decree, leaving domestic players with a captive market. I mean, look at a company like Century Aluminum, ticker CENX, or look at the major U.S. steel producers. These stocks become plays on government policy rather than pure business execution. The market is starting to sniff this out, but it hasn't fully priced it in for what happens when these tariffs stick around for the full fiscal year of 2026. We are talking about complete repricing of domestic industrial assets. But here's the risk, and this is where you have to be a little bit careful. One man's margin expansion is another man's input cost crisis. The flip side of this trade is the cost crush on retailers and manufacturers with complex global supply chains who just can't pivot fast enough. If you are a construction firm, an auto manufacturer, or a heavy equipment maker, your raw material cost just went vertical. You can't just flip a switch on suppliers overnight. Building a supply chain takes years. Signing an executive orders takes seconds. So you have this massive divergence opening up in the market. On one side, you have the producers who can raise prices on a whim. On the other side, you have the consumer of those raw materials who are seeing their margins evaporate. This is where the trade lives for 2026. It's not about just buying American. It's about buying the top of the supply chain and possibly shorting the middle. Watch the spread between domestic producers and import-heavy retailers. That gap is going to widen in 2026. You want to be long the guys with the smelters and blast furnaces in Pennsylvania, Kentucky, wherever else, and you want to be very, very cautious around the companies that are importing widgets made from steel that's smelted overseas, or even domestic companies that have to buy that now very expensive U.S. steel to build their products. The market usually treats tariffs as a temporary negotiation tactic. Traders think they'll strike a deal in 6 months, but this reciprocal order is different because it's written into the framework of how the U.S. trade works. It sets a new baseline. It creates a protective moat around heavy industry that's almost impossible to breach without a change in the administration. You also need to watch the timeline. These orders were signed in 2025, but the inventory cycles mean the real pain and the real profit is going to be hitting the balance sheets in 2026. Companies that have been burning through their old cheap inventory for the last year, well, now they have to restock at new rigged up prices. That is when the earnings calls start getting a little bit interesting. That's when the guidance gets cut for the importers and raised for the domestic producers. So don't get distracted by the trade war rhetoric. Look at the sector rotation. This is a transfer of wealth from companies that move goods to companies that make the raw materials, especially here in the United States. It creates a very specific, very tradable trend. You look for the domestic producers with the highest operating leverage. These are the companies that make more money for every dollar the price of the commodity goes up. With a 50% tariff shield, that operating leverage is going to print cash. But wait, because while the industrial sector is getting a wall built around it, the healthcare sector is about to get smacked in the face with something even more aggressive. If you think steel tariffs are disruptive, wait until you see what they just did in the pharmaceutical supply chain. It's the same playbook, but the stakes are life and death, literally. The money involved is significantly larger than steel. Now, if you think the steel situation is pretty wild, what's happening in healthcare is on a whole entirely different level. The headline everybody read was lower drug prices. Sounds great on the campaign trail. Sounds like the government is going to negotiate with Medicare, crush the margins, help out the consumer, the little guy. But if you ignore the press release and actually look at the actual mechanism that was written into the order, the story is completely different. The mechanism isn't price controls. It is a brutal, uncompromising 100% tariff on imported pharmaceuticals. Let's stop and think about what that actually means for the market for just a moment. This isn't a subtle tax. This is a complete restructuring of the global supply chain. For the last 30 years, the pharmaceutical playbook was simple. You invent a molecule, you do it in Boston, San Francisco, somewhere else in the US, you manufacture that pill, India, China, you can do it for pennies on the dollar, and then you sell it to the US consumer for massive margins. That arbitrage, it's dead. The order effectively kills the business model of innovate here, make it over there. The insight the retail crowd is missing is that this order creates a massive moat for the companies that already spent billions of dollars building capacity on US soil. This isn't about punishing the industry, it's about picking the winners within the industry. It creates a protected class of companies. If you are a company that has been pouring concrete in the Midwest or the South, building a sterile facility and navigating the never-ending FDA approval process for domestic plants, you just won the lottery. You didn't just get a tax break. You got a government-enforced monopoly against all of your competitors who rely on cheap overseas production of drugs. This is where the rig comes from in this order. Look at the giants here. Eli Lilly, ticker LLY, and Merck, ticker MRK. These companies have massive domestic manufacturing footprints. They've been building this capacity for years, not because they knew this order was coming, but because they wanted some supply chain security. Now, that security has turned into a weapon against some of their competitors. They can produce their drugs without the tariff penalty. Meanwhile, their competitors, especially the generic manufacturers who rely heavily on factories in Asia, suddenly they're facing a 100% cost increase. They're priced out of the market by decree. The evidence is already in the CapEx numbers, the capital expenditure numbers. We have seen over $270 billion pledged for U.S. manufacturing in this healthcare sector. The media spins this as investment innovation or job creation. But don't be naive here. That's $270 billion, and it's not charity. It isn't about better drugs. It's a survival fee. CEOs are smart. They know that to sell in the U.S. market in 2026 without getting crushed by tariffs, they have to make the product here. They're paying to stay inside the wall. This massive CapEx spend is the administration ticket to the protected market. This leads us to a very counterintuitive point for 2026. As traders, we're trained to look for the best drug. We look at the phase 3 trial data. We look at the efficacy rates. We look at the patient cliffs. But in this new environment, you have to change your filter just a little bit if you're looking at pharma. Don't look for the best drug. Look for the best factory. In the US, in 2026, supply chain geography matters more than intellectual property. You can have the cure for the common cold, but if you can't get it into the country without paying double price penalty, your margin just got wrecked, and your stock is dead money. You have to understand the bottleneck that this presents. You can't just spin up a pharmaceutical factory overnight. It takes years and years to build, years to validate, years to get FDA approval. It seems like it never ends. The companies that have that capacity now and it's open are the ones that are going to dominate that market in 2026. The companies that are scrambling to get started building something here, they're too late. They're going to be eating those tariffs for years while their competitors steal away their market share. So here's your actionable take. You need to audit your healthcare watch list. Go into those 10K filings. Look at the properties section where the primary manufacturing facilities are. Where are they located? If they make their key products in New Jersey, North Carolina, other places in the US, they win. They have pricing power and margin protection. If they make their key products in Shenzhen, Mumbai, India, they lose. It's that binary. The market is going to bifurcate into domestic producers and import victims. You want to be long the factories, short the importers. This is a total reversal of globalization trade that we've seen for decades. It's a messy, expensive, and it's going to cause shortages in certain drugs. But for the companies on the right side of the order, it's virtually a license to print money. While the pharma sector is busy building walls to keep competitors out, the financial sector is kind of doing the exact opposite. They are tearing down the walls that they have held onto for years. People hear the word deregulation and their eyes pretty much glaze over. They think it just means less paperwork for compliance, maybe fewer safety inspections at a factory. But in the financial sector, deregulation is code for revenue unlock. It's the single most bullish signal that a government can send to Wall Street. The retail crowd thinks deregulation is about ideology. The smart money knows it's about leverage. And this specific order, the one rolling back the competition, mandates the so-called fair banking restrictions. It's effectively a starter pistol for a race that's been on pause for 4 years. Here's the insight that changes how you trade this. The last administration used executive orders to freeze consolidation. They wanted to prevent banks from getting too big to fail. Well, this new order kind of flips that logic on its head. The repeal of those competition orders is actually a green light for some massive mergers and acquisitions. And we might have an M&A consolidation super-cycle. We have thousands of regional banks in this country right now that are absolutely drowning in compliance costs and underwater on commercial real estate loans, CRE. They've been desperate to sell, and the big players have been desperate to buy, but the regulators won't let the deals happen. Well, that roadblock, it's gone. The rig in this instance here is that the government is effectively telling the banking sector to eat its own tail. The removal of capital requirement handcuffs allows the major players, the systematically important banks, to deploy cash that was legally required to sit dead on their balance sheets for years. Think about what that means for just a moment. Banks have billions of dollars trapped up in those reserve requirements. It's kind of dead money. Earns nothing, does nothing, just sits in the account, backing them up. This order lowers that drawbridge. That capital is now free to be used for stock buybacks, dividend hikes, and most importantly, acquisitions. You're going to see a feeding frenzy in 2026 where the strong eat the weak and the stock prices of both the acquirers and the targets get bid up in the process. It's a government-sanctioned consolidation of wealth into fewer and far more powerful hands. But the wildest part of this deregulation order isn't even about traditional banking. It's about the digital side. The rollback of SAB 121 is the sleeper hit of the year. Most traders don't even know what SAB 121 is. It was an accounting bulletin that effectively made it impossible for banks to hold cryptocurrency for their clients. It required them to hold $1 cash for every dollar of crypto that they custodied. It made the business model unprofitable by design. It was a silent ban on holding crypto for your clients. This order kills that rule. And by killing it, it doesn't just help crypto, it allows massive institutional custody of crypto. It essentially lets the biggest banks in the world monetize Bitcoin holdings for the first time. Up until now, if you wanted to hold Bitcoin, you had to go to a crypto native exchange or hold your own keys, do your own custody. Now, your legacy bank can offer you crypto custody and charge you a fee for it if they want. This integrates the entire crypto asset class into traditional banking revenue streams. That is a seismic shift in how money flows. The evidence was instantaneous. Look at the reaction in a ticker like Coinbase, simple ticker symbol COIN, or Financial Select Sector Spider XLF. The market sniffed out the profit margin expansion before the ink was even dry on the order. Coin popped because the regulatory cloud had been lifted. XLF popped because the banks just got permission to become some deal makers once again. The market realized that the friction costs of doing business just went practically to zero. So how do you trade this? The actionable take here isn't just to buy banks. That's too broad. A savings bank that just takes deposits isn't going to see explosive growth. The trade is buying the deal makers and the exchanges. You want to own the companies that benefit from increased velocity of money. When the M&A heats up here in this sector, the investment banks that advise on the deals, they're probably going to make a fortune. When the crypto custody goes mainstream, the exchanges and their custodians see their volumes triple. You're looking at infrastructure plays of the financial world. The guys who charge the money for the toll on moving the money. This is the deregulation super-cycle. It's a period where the rules are rewritten to favor volume, leverage, and speed. The banks are going to get bigger, the crypto market is going to get institutionalized, and the regulatory ceiling that capped valuations for the last few years has just been blown off the hinges. But there is a catch. All this newly unlocked capital, all this dead money that is now suddenly live ammo in the market, it needs a place to go. Banks just can't sit on this. They have to deploy it. And the government, in its infinite wisdom, just pointed a giant neon sign at exactly where the money should flow. And it's not going to go into savings accounts. It's not going into bonds. It's headed straight into the pockets of the most aggressive asset managers on the planet. The fourth order is the one that sounds the nicest, but it's actually the most cynical maneuver in the entire list. It's titled Democratizing Access to Alternative Assets. When you hear that title, it kind of sounds like the government is finally looking out for the little guy. It sounds like they want the average plumber or teacher to have access to the same high return type of investments that billionaires have been hoarding for decades. It's framed as an equality measure. It's framed as a fairness. But whenever you see the government use the word democratizing, in relation to financial markets, you probably should put a chain around your wallet and check for holes, because what that order is actually representing is a $1 trillion liquidity exit strategy for private equity industry. And you are the designated bag holder. Here is the reality of this situation. Private equity firms, the guys who buy companies, load them with debt, and try to sell them for a profit, they have a massive problem right now. They are sitting on trillions of dollars of assets that they bought during the cheap money era of 2020 and 2021. They paid top dollar for these companies. Now that interest rates are higher, the IPO market has been frozen up. They can't find anybody to buy these assets from at the prices that they need to turn a profit. They're kind of stuck in the mud. They're stuck in illiquidity. The smart money institutional investors, the pension funds, the endowments, they're tapped out. They aren't writing any new checks. So the private equity giants need a new sucker, new fall guy. They need a new source of fresh, dumb capital to buy out these bad positions. And this executive order hands them the keys to the biggest vault of dumb capital in the world. That's the American 401k system. By directing the Department of Labor to allow alternative assets into default 401k plans, the government has effectively connected a fire hose from your paycheck directly to private equity balance sheets. And we're talking about a passive flow of capital that happens every 2 weeks when people get paid. Automatically, regardless of market conditions. This is the rig in Executive Order number 4. It opens a $1 trillion floodgate of passive retirement money into assets that are notoriously opaque, hard to value, and impossible to sell very quickly because they're illiquid. For the retirees, this is a potential disaster. You're taking liquid cash and locking it up in illiquid private deals, but we aren't here to debate retirement policy. We are here to trade this reaction, and the reaction here is going to be potentially massive. An artificial boost to the valuations of these asset managers themselves. You need to look at the tickers that manage this money. I'm talking about Blackstone, ticker BX. I'm talking about KKR and Company, tickers KKR. I'm talking about Apollo Global Management, their tickers APO. These are the companies that just got access to the deepest pool of capital on earth for 2026. Think about the business model. These firms make money on fees. They charge a management fee on assets under management. Before this order, they had to go out and beg sovereign wealth funds or university endowments for that capital. That's hard work. Those clients are sophisticated. They ask some really tough questions. But now, they can just get slotted into a target date fund that 40 million Americans blindly contribute to every paycheck. It's sticky. It's permanent capital that doesn't ask questions. There's nobody there. The evidence of this shift is already showing up in their earnings calls. They're pivoting their entire sales force to target wealth and retirement, those channels. The market knows this is coming. If you look at the chart of Blackstone, it acts like a vacuum cleaner for capital. This order effectively guarantees their growth rate for the next decade. It allows them to offload their illiquid real estate and corporate debt into your retirement account, your 401k, freeing up their balance sheet to go look for new deals. The setup for 2026 is a massive repricing of these alternative assets. If you have a legally mandated bid, if 401k funds have to buy a certain percentage of private equity, then the price of those assets cannot go down. It creates an artificial floor. It's the same dynamic we saw when passive indexing took over the stock market, but now applied to private markets, so the action we'll take is very specific. Do not go out and try to buy the private equity funds themselves. Don't try to get into the Bright Fund or some non-traded real estate investment trust. That's where the fees eat you alive. Instead, buy the managers of the market. Buy the stock companies that collect the toll. When billions of dollars flow from 401ks into private equity, Blackstone, KKR, they get a cut out of every single dollar. They win whether the underlying investments go up or go down because they get paid on volume. This is a transfer of liquidity from public to the private, and it's your 401k. It's a bailout in disguise as opportunity for 401ks. And as a trader, you want to be long the guys that are holding the life raft. The smart money is positioning for a world where private equity becomes standard utility in every portfolio. And the fees associated with that are going to drive these stocks to all-time highs. But once all this capital is unlocked, once the banks are deregulated, and the private equity firms are flush with 401k cash, where's it all going to go? The government didn't just unlock the money, they also gave it a destination. They just pointed another giant neon sign to the energy sector. This is the final piece of the puzzle. This is where the digital world crashes head first into the physical reality of the power grid. For the last decade, tech has been a software game. You bought code, you bought users, you bought intellectual property, but the Develop First executive order fundamentally changes this sector from a software play into a hardware and real estate play for 2026. This is the one pivot point for 2026 that you should pay attention to. Here is the observation that most people are missing. Everybody knows AI is pretty huge. Even everybody knows that NVIDIA is selling chips as fast as they can make them. They're sold out. But the limiting factor for AI isn't silicone, it's electricity. You can have all the H100 GPUs in the world, but if you can't plug them into a gigawatt scale power source, they're kind of expensive paperweights. The grid, it's pretty tapped out right now. Permits for new transmission lines usually take 10 years to get approved. But with this executive order, which creates a national security fast track for critical technology infrastructure, effectively slashing that timeline from years to months. The insight here is the government is subsidizing the capital expenditures of the AI arms race by removing the red tape. They aren't writing a check, they're writing a permission slip by declaring data centers and the energy infrastructure that powers them as a strategic national asset. They're bypassing the local zoning boards, the environmental impact studies, and the not in my backyard lawsuits that kill construction projects. This is a massive hidden value unlock for companies that build physical backbone of the internet. This is the rig in the final order right here. It removes the biggest bottleneck for AI scaling, power and land, and guarantees that companies like NVIDIA, ticker NVDA, and the major data center real estate investment trusts have a clear runway for 2026. It creates a protected lane for development where the normal rules of construction no longer apply. If you're building a shopping mall, you have to wait 3 years for a permit. If you're building a data center for American AI dominance, you break ground next week. The evidence is in the correlation between energy deregulation orders and the tech export promotion orders. These two things are working in tandem. The administration is pushing for cheap, abundant U.S. energy, natural gas, nuclear, whatever we can get working today, specifically to feed the ferocious appetite of these data centers. It creates a feedback loop where cheap U.S. energy powers high-margin U.S. tech exports. The government realizes that to win the AI war against China, they can't just have the best code. They need the most watts. This is a setup that creates a fascinating dynamic for the energy sector. Utilities are usually slow-growing, boring stocks. They're widow and orphan stocks that pay a dividend and kind of do nothing else. But under this order, utilities effectively become growth stocks. They're the only ones that can sell the raw materials that the trillion-dollar tech companies are desperate to buy right now. We're seeing power purchase agreements being signed at premiums that we've never seen before. Tech giants are literally buying nuclear power plants just to secure the juice that they need. However, there is a massive risk warning right here that you have to respect. This is the ultimate picks and shovels type of play, but you need to be careful which shovel you buy. The software companies, the ones building the chatbots and the agents, they might fail. We could see an AI bubble burst where 90% of these startups go to zero because they can't figure out a business model that actually makes money. But here's the beauty of the infrastructure trade. The guys selling the electricity and the servers, they get paid regardless. Even if the AI startup goes bankrupt, they still have to pay their electric bill. The data center lease is still a binding contract. So the action we'll take is to look at the intersection of utilities and data centers. That's the safest bet on this policy shift. You want to own data center real estate investment trusts like Equinix or Digital Realty, but you also want to own the independent power producers and the progressive utilities that are aggressively building out capacity in data center hubs like Northern Virginia and Texas. The trade is to be long the physical constraints of AI. Don't bet on who wins the chatbot war. Bet on the landlord who owns the server farm and the utility company that keeps the lights on for it. This order cements the reality for 2026. The stock market is no longer just about earnings per share, it's about policy alignment. The companies that align with these executive orders that I just outlined, the domestic steel mills, the onshore pharma plants, the deregulated banks, the private equity giants, and the energy-hungry AI infrastructure are the ones that are going to catch a bid in 2026. These companies fighting against this current, they're going to go down. The whole situation here proves that the market doesn't care about fairness, political ideology, or your personal feelings about it. It cares about liquidity and rules. And these 5 orders that I just talked about rewrote the entire rulebook for 2026. The playing field has been tilted, and you either adjust your stance or slide off the map. Drop a comment below which sector you think gets hit hardest and which one benefits the most, and make sure you subscribe so you don't miss the next breakdown of where I think the smart money is moving next. And check out one of these videos right here. See you on the next one.